As some of you know, I had my birthday last week. I turned 42. And I started thinking about my 20s and 30s and how I could basically do anything to my body. I could eat a dozen jelly donuts a day, drink as much as I wanted to, never exercise, and it seemed like my body stayed strong or was getting stronger. And then in my 40s, that really didn't hold true anymore. I can't do those same things anymore, and my body is not getting stronger. My job now is to maintain or slow the melt. And when the stock market is going up like it did from 1982 to 2000, it's kind of like your 20s and maybe 30s or early 30s, where you can basically do anything you want to your body and it won't really show the age. It won't really show the wear and tear. But man, when you get into your 40s, that's when you're going to really have to maintain. And the 40s and the 50s and maybe so on is really like a sideways market in the stock market from the year 2000 till today, about 13 years and counting. We probably have about 5 more years. And you can't really hide not working out. You can't really hide that you've been treating your body badly. You can't really hide that you didn't really know how to grow money. And that's where we are today, and it's not over. We have 5 more years. And the place my attention goes is if people have already crash landed their portfolios 2 or 3 or 4 times in the last 10 or 12 years, there's probably 1 or 2 crash landings before we get out of this sideways market in 2018. And so I thought about calling whatever Bernanke and company is doing is call it the 1% recovery, which is really driven by the imagination of central bankers. And the way it affects people is basically if you are paid to think, you have the ability or the choice to gain wealth. You may or may not actually gain wealth, but if you're paid to think for your intellectual property, almost anyone living in Silicon Valley who works for Cisco or Oracle, Google, Facebook, Apple, any of them, they're usually being paid because of their brain. So, they'll be able to maintain. Maybe some of them will be able to gain wealth. But if you're paid to sweat, if you're paid to lift things, if you're not paid for your brain and your intellectual property, let's call that the bottom 97% of the country, then you're really screwed because the 1% recovery driven by the imagination of central bankers is not going to help those people. Now, even if you're not one of them, if you live on this planet or live in the Western world, and the Western world is not necessarily a geographic location, then the bottom 97%, as they get poorer, that's going to affect the economy eventually, after the imagination of the central bankers is taken out, and it will eventually. Now, ultimately, this is going to fail. What I mean is ultimately the 1% recovery will fail and things will revert. There'll be the great resetting. And I want to show you why. I want to show you what you can do. So the first thing I want to show you is the 4th Congressional District of Illinois. And the reason I want to show you this image is this is government. This is politicians. This is how they think. The entity that designed the 4th Congressional District of Illinois, which is what you're looking at here on the screen, these are the same people that are in Washington. These are the same people that are at the central bank. These are people that are making policy. This is why it will ultimately fail, because it is manufactured, it is broken, it doesn't work. And there's a very, very long history of politicians pulling the temple down on themselves. Now, I can prove to you that it's not working because if you look at the screen here, the red line shows you that back in 2000, the median household income in the United States was about $41,000, and today it's about $51,000. So you say, hey, RC, people are making $10,000 more. But if you put your eyes on the blue line and you adjust that for inflation, you see that people's real median income has gone from $56,000 down to $51,000. So they've lost 10% of their income. This is going to impact the long-term trajectory of the entire West. And you get this because of manufacturing and manipulation and intervention. I'm not saying it's going to stop. I'm simply pointing out the effects, the long-term effects of this. You have 6 graduating classes and counting who are sleeping at home on the couch and working at Starbucks as baristas because the normal price discovery mechanism of the economy and the stock market is broken. That is not good for the market. And it's not going to stop anytime soon. If you look on the screen here, you can see the 10-year yield for the U.S. Treasuries, So I just point out a couple things here. People think that overnight yields are just going to take off to 5 or 6 or 7%. Well, that may happen. It certainly happened in 1974 to 1982, as you can see on the chart within the vertical rectangle. But if you look over to the left, you'll see a horizontal rectangle, and you'll see that yields, the 10-year bond yields, stayed below 3% for 18 years. So it's more likely that we'll have a bottoming. And given that the bottom 97% of people are getting poorer, and anyone who's paid to lift or sweat for income are getting poorer, and even people in the top 3%, certainly the top number 98, maybe not the top 1%, they might not even be gaining wealth anyway. So this is a long-term thing that is not going away. Now, if you think rates are just going to go up, and the reason I'm talking about rates is because over the last month, the 10-year Treasury has gone up above 2%, which is pretty impressive. But if you look at the screen here, you can see that there's three there's 3 lines. 2 of them are shaded. One is the Japanese lost decade or 2 decades, and that is the light greenish line. The light grayish line is the Great Depression. And you can see that there wasn't just a kind of a fall and then take off again. So most likely we're going to have a lot more sidewaysness in rates than anyone even thinks. We can go years with this. The central bank can think about keeping rates low and sideways for years. They're not in any rush. The point that I'm bringing up is that this is going to create a lot of unbalancedness in the world. The screen you're looking at right now is the median new home price in the United States. This goes back to 1986. Today, new home sale prices in the United States have never been higher. They're at a lifetime high. And personally talking here in Silicon Valley, Palo Alto hit lifetime highs last year or the year before. And all over the peninsula here in Silicon Valley, real estate is going absolutely crazy. 15, 20% in 1 year. And this is because inflation will not squeeze out evenly across the country. It will kind of squeeze out in certain areas. And right now it's clearly squeezing out in real estate property in Silicon Valley and other parts around the country. Phoenix is having a huge part too. Now, this all comes to one thing. It all boils down to one point, and this is the one point I want to make to you this week. If you lost 50% of your portfolio in 2000 or in the 2000 crash, and then you lost another 50% of your portfolio in the 2008 crash, and you lost all of your real estate, or you got greatly hurt by your real estate holdings falling in 2007, 2008, 2009, and you've been badly hurt by gold falling over the last 18 months, that means you haven't adapted. And it's not the strongest nor the fastest that are going to survive, but it's the ones that best adapt to what's going on. So adapting to what's going on today is what's going to help you protect and grow your money. And you don't adapt by finding a ticker symbol or a sector. You adapt by finding strategies that adapt. And that's what I want to leave you with, is for you just to think about it this weekend. What have you shifted or changed with your strategies? And I don't mean going from Merrill Lynch to Ameriprise or Ameriprise to Raymond James or Edward Jones or Morgan Stanley or JP Morgan. That's the same thing. It's the same person. I mean, really, what has been shifted? And please don't tell me before I bought this and now I bought this. The shift cannot be in sector or asset class or stock. It has to be an approach. That's what a real shift is. So that is that's my idea that I want to leave you with this week. Of course, we have the monthly strategy gathering coming up in less than 2 weeks on June 11th. I'm going to stream it live at 11 a.m. California time, Pacific Standard Time, and I'll stream that live. And we're adding a couple new ticker symbols to Obvious Trend. We ourselves are also adapting, and I look forward to having you on that call. And thank you for being in my world, and you guys have a great weekend.